Hey guys, this is Karthikeya Kantwal again from Apex FinServe, and well, the weekend is here, so instead of discussing new scripts and the indices, we'll be discussing a new concept that many people overlook oftentimes when when they refer to price action or they talk about price action trading. This is one such thing that they leave behind or they completely ignore most of the times. Now, that is what I'm talking about here is basically phase analysis. Now, let's say you have a complete technical system designed around your trading ideology. You have a counter trend system or a trend following system, it can be anything. But before putting any of that to proper use, before utilizing any of those concepts, any of those indicators efficiently, you should be able to clearly and decisively understand where the market is headed, or at least where your particular chart is headed, if not the entire general market. Now, to do that, price action is one of the simplest methods and one of the most efficient ones as well. What we do for coming to a conclusion, or what we see, is in simple words what you have been watching me do, or what you have been discussing with me all these days. The watches has been discussed. I talked to you guys about the structure formation, the higher high, higher low, and the lower low, lower high formation. Well, that is what we call the market phase analysis. So basically, a market has two phases, trending and non-trending. So within trending itself, we have two possible market directions: upwards, downwards, as you all might be aware. In normal terms, that is known as an uptrend or a downtrend. But when we talk about specific price action structures that define these trends, so we have a higher high, higher low structure, which defines an uptrend, and a lower low, lower high structure, which defines a downtrend. Now, an uptrend, the reason why higher high, higher low defines an uptrend is every time that a swing high or a previous swing high is being taken out, it signifies that the ongoing demand is now greater than the previous demand, as a result of which the price is now being driven harder and higher. Whereas the opposite is true for the lower low, lower high formation. The supply is now stronger, hence the lower lows. Every time there's a pullback, the new demand in case of lower low, lower high is weaker than the previous, hence the lower high. And same goes, not same, but the opposite stands true for the higher high, higher low, where we have a higher low. So the higher low stands for a decreased supply. As a result, it defines a trending market in either direction. There are lots of ways to perform phase analysis in the markets. As with everything in price action, phase analysis is also completely subjective. Now, we'll be discussing some key points about phase analysis, how to do that, and at the very end, we'll also be going through a chart. However, before we begin with the discussion, the charts, and all of that, I'd like you guys to know that I've already covered this content in the Apex Education Telegram channel. So, if you're not much of a video person, if you want to read about it, you can directly go to the channel and simply search or scroll up, you'll find it. I am attaching the link in the description below. That's a completely call free or trade free channel. There's only concepts that are being explained, so you might as well join the channel. However, if you're not much of a reader, well, we've got that covered for you. We'll be discussing it all today anyway. So starting with the structures themselves, the higher highs and higher low patterns. As I told you guys just now, the uptrend signifies that every time this high is being broken, if you compare these highs, these higher highs, now a higher high is only going to be formed if the new demand is going to be greater than the previous demand. As a result, the price is going higher, and the higher low is only going to be formed if the supply that came into action at the high point, the high one, is lesser than the supply that came into action in the high before that. As a result, the higher low, because the price is not going further below the previous point. Same goes, not same, but the exact opposite stands true for the downtrend structure, the lower low, lower high pattern. Lower lows are only formed when the supply is, the supply at every downfall is now increasing when compared to the previous supply, as a result of which the price is being driven further down and lower lows are being formed. Lower highs are formed when the demand at every time or at every support level, every demand zone, this new demand is now lesser than the previous demand at the previous low, because of which lower highs are being formed. Now, if we take this example on a chart, so first of all, you need to define what is a swing high and what is a swing low. Now, very simply put, or fundamentally, A swing point is any point where you see visibly on the chart that the shift in power is happening from the demand to the supply or from the buyers to the sellers. Let's say the price was continuously going up, all of a sudden it starts coming down. That point from where the downturn started, that's going to be your swing high, and vice versa for your swing low. Now, you do need a couple of practice. You don't need a couple of practice. That doesn't make sense. Now, you do need a healthy amount of practice when it comes to identifying quality swing high, quality swing lows. And as I told you guys, subjectivity, that is where it comes into play. The better you get at identifying swings, the cleaner your phase analysis is going to be. Now, there are a lot of key pointers that you can take away from these structures on your chart. Now, what we have on the screen here is a simple higher high, higher low structure formation, and the transition of it from higher high, higher low into same highs, lower highs, and then lower low, lower high formation. Now, when we start on the left hand side, I have marked the swing high points and the swing low points for easier identification. So when we start from the left hand side, it is clear higher high, higher low structure formation. However, the first lower high that we have at this point, now that is signifying that the demand is exhausting. It is starting to vanish. It is starting to fade out at this point. As a result, the price is not able to break the previous high. So the higher high, higher low pattern that we had, that is now starting to be invalidated. However, the confirmation that we get is when the first lower low is formed when compared to the previous low. What that means is that the supply that came into action at this high point, this lower high point, that supply was marginally or exponentially greater depending on the difference between the low points. But the key thing is it is greater than the previous supply. So now it has now transitioned into lower low, lower high patterns, which is basically uptrend to downtrend market transition. A very simple example. Now the thing is that this is a post market example. It is very simple to track them. The problem that you have is how to identify these structures in running markets or even after closed market, how to come to a conclusion of how to trade to them. Now this is just an example. There are a lot of other factors that you can use from these structures. There's the steepness of the trend. Now the common idea is that if a trend is to be sustainable, it needs to be forming gradual higher high, higher lows, and not exponential higher high, higher lows in the case of an uptrend, which means it should be going up sustainably in a ranged manner where all of the candles are balanced evenly and not in sudden spikes. If there are spikes, that means that demand is unreal, that demand is not sustainable. Same goes for the downside as well. Now there is another concept that we have in mind. There is another concept that comes into play, that is the concept of trend lines. Now once you have a idea of how to mark these swings and you have learned how to identify these swings and you are now performing phase analysis, now that solves the trend line issue completely, because a trend line is nothing but joining of consecutive swing lows or consecutive swing highs. If it's an uptrend, you'll join swing lows so that you have an upward sloping trend line with the support levels. If you have a downtrend, you'll join the consecutive swing highs so that you have a downward sloping trend line with the resistance, which signifies a break of trend. Now this steepness of the trend line basically justifies how sustainable that is going to be. If this trend line is very heavily rigged, if it is completely upwards, then that is not sustainable. The trend line is going to be broken sharply. Same goes for the downside. The example that we have here is a pretty normal one. It is a moderate trend line. However, we can see every time that the price has gone up, the distance between the highs has decreased, which means that the demand is stronger, but it is not a lot of times stronger. So it is still more, but not healthy enough to push the trend into further higher high, higher low formation. And then that resulted into formation of a lower high, but we did not have a confirmation at that point of a lower low, so we would not have entered into a position there. Yet again, it made a similar high or even a slightly lower high, which shows further weakness, and then it resulted in a break of trend line, which then had role reversal and then a complete transition into lower low, lower high formation. There's the length of the trend line, steepness, and the smoothness of the trend line. These are all small things that you can figure out by yourself that whether it works for you or not. What are the parameters that you keep for yourself? Now, when we talked about the slope of the trend line, so the slope of a trend line, it basically signifies the strength of the underlying trend or the direction of the trend line. If the slope is getting aggressively angled on the upside, or if there is a slope, if the slope is increasing, basically the trend is gaining strength. If the slope is decreasing, the strength of the trend is fading. Now, the final nail in the coffin for any trend has to be the break of the trend line. That basically signifies a reversal, or at least invalidating that trend. It might be range bound or reversed after that, depends on further price action. Now, there are a few other pointers as well that you can use to quickly come to conclusions whether that trend is sustainable or not. Now, typically, a trend where the candle bodies do not overlap signifies strength, as the price is showing one sided moves. Now, when I say that the candle bodies do not overlap, that means in an uptrend, every candle in itself has to have a higher high, higher low. There should be no opposite engulfing, there should be no opposite sided dojis or anything as such. Then you have, as I said, you should have evenly ranged candlesticks. If the candlesticks are getting increasingly smaller in nature, that means that the opposite side might be increasing in its strength, or the favoring side for the trend might be decreasing in its strength. Can be either of the two, but basically the candle range should be evenly balanced throughout the trend. Should have healthy ranged, moderate bodied candles. I'm not talking about complete marabosus, but they should also not be completely worthless dojis. It should be a healthy balance of both. Then you have gaps on your charts. If you're using a large time frame, hourly or daily, there might be some gaps on your chart. If the trend is still pushing in that direction despite a gap on the opposite side, then it is definitely a strong trend. When I talk about the slope of the trend line, this is one good example. If I had drawn, not if, well, I have drawn a trend line here. Well, this is a downward trend line. As you can see, it made a lower low lower high formation. I made the trend line. The breakout, as you can see, it was very sudden and very steep in nature. So this signifies a very strong trend. As you can compare the trend lines for both, the trend line for the breakout is a very steeply rigged trend line when compared to the trend line for the downward trend. So you can see that the breakout was a lot stronger, or even exponentially stronger than the downtrend that came before it. And every time you can see it went up, the higher lows that were formed were very marginal or very small in nature when compared to the higher highs. Now, moving on to the charts that we have. Now, what we discuss right now, pretty much all of it theoretical. Now, when we come to the chart, things start getting simpler. Well, I would say, at least for me, because I have been using these basic things since a very long time, and I find them to be very efficient. It should get simpler for you as well once you get used to the concept. Now, this is the chart of Piramal Enterprises. The time frame that we'll be using is 15 minutes, because I think most of you guys are strictly intraday traders. 15 minutes is a balanced time frame. It is not too aggressive or ambiguous, such as 1 minute, 5 minutes, and it is not overly conservative and imbalanced as the daily or 4-hour time frame. So we'll be using 15 minutes. Now, as you can see on the chart, now based on the examples that I had shown to you guys, this is a very clearly a higher high, higher low formation. Now I have a prepared chart of this just to keep things smoother and to keep the video shorter in length. So this is the same chart. The green lines that I have for you are the higher high, higher low pattern formations, and once that was broken, we had the lower low, lower high. But starting from the left hand side, we can see that this was the swing high. This is the swing low from where it all started. As you can see, there was selling pressure. It wavered off at this point, it tapered off, it faded, and resulted in upside movement. Now that upside movement went all the way till the resistance level, from where it started coming down. On its journey down again, it did not come all the way down to the previous low. Instead, it made roughly a 50% retracement of the swing movement and then again went up. Now there's one key thing. If you notice the distance between this swing high and this swing high, it's not really that much. So which means that the move that came from this swing high, or the strength of demand that resulted in the move of this swing high, formation of this swing high, is not that much stronger than the swing high. As a result, the pullback that we had was also more or less the same length of the previous one. Now, what happened where we actually ran into some issues where there was a time on this chart when it transitioned from neither higher low and nor the lower high formation and into completely range bound, which is this particular time. Now, as you can see, it made the higher high. It made this higher high at 1427. After that, it even made the higher low at roughly 1400. There, it started facing some issues. It seemingly ran out of buying pressure. It could not break the high again. But the problem was, it was neither making lower lows either. It was not making higher highs, but it didn't make lower lows either. So it went into a range. It gathered some buying pressure again, and it strongly broke out of that range. Now, if I were to draw a trend line, this is what I would get. This trend line signifies my upward trend movement. This trend line signifies that the chart was bullish. Once this trend line was broken, which also happens to be when the previous swing low was taken out, I can confidently say that it has now transitioned from making higher lows into lower highs, which was confirmed when this sudden selling pressure broke the previous low. Now, PL started coming up again. It tried to reclaim its higher low pattern, and sadly it couldn't. It ended up forming the same high. So as a result, it is still bearish. It is definitely not bullish anymore unless some news comes in and something goes wrong in the. Now I can further cement my bearish nature because it made a lower low in the pressure. When it was coming down again, it made a lower low. Again, it started going up. This time it could not even go all the way there. It made it made a lower high, and then again started coming down. Now at this point, my trade bias personally would be either to take a trade above the previous swing high or under the previous swing low. A very simple method to trade, but honestly it works. Now the reason why these structures work, the reason why these things work, that's because, well, you are basically reading the candle movement and nothing else. So let's say you come to a conclusion that something is bullish, something is bearish, so and so. Now if the price itself is not agreeing with you, if there are no structural formations, if price action itself is not giving you that same conclusion, then there's no possible theory, there's no indicator that can magically turn the price into your favor. There's no indicator that can decisively change the market movement or alter the structural formations. Now as traders, it is important to keep in mind that you are not there to predict the market. You are there to read the market fluctuations and react to them efficiently enough so that you end up making money from it. That is what we are trying to do through these structures. We are basically reading market movement. We are trying to decipher the direction that the market is heading and trying to align ourselves with it depending on our trading ideology. Now we only had one chart to discuss. You can practice this on literally any asset. You can do this on any asset type. You can do this on indices, commodities, equity, FNO, every single thing. It is going to work because it is price action. It is universal in nature. There should be no problem with it whatsoever. Now if you want to read more on it, then you can go to the post that I have written on Telegram @Apex Education. I'll be posting a link to that in the description below. I hope this discussion added value into your trading insights, and I sincerely hope that you are able to put this to use. If not, you can always hit us on the back support channel even for all the questions and doubts that you have. If you have some immediate doubts pending after watching this video, comment them down below and I'll go through them. If I can, I'll try to answer them in the comments itself. If not, hit us up on Telegram @Apex back support. We are always available, almost always, not always. We are almost always available to answer your questions. Now this is all that we have for tonight, guys. I hope you have a good quality weekend wherein you're coming in fresh for the next week's trading session. I'll see you guys again on Sunday evening, where I'll be coming back with the trades for the trading session for Monday. Thank you so much for watching, guys. Have a good night. Bye.